$5 billion? Think about it. If you're an auto policy holder, you may see roughly $100 coming your way in the next couple of weeks. That sounds like good news, doesn't it? But over the last few years, many of you have watched your premiums as they've skyrocketed from 40 to even 50% increases. So here's the question. If things are so healthy in the insurance business, why are they sending us money back? What has changed? That's the part that I want to understand today. So today what we're going to do is three things. First, we're going to try to explain who qualifies and how this dividend actually works. Secondly, what we want to do is look at the math behind the increases. And then third, we'll examine why a dividend may have been the strategic choice instead of just lowering your base premiums. So let's slow things down just a little bit here and look at the system involved. On February the 26th of 2026, State Farm reported a meaningful rebound in their financial results. Auto underwriting improved. Investment income strengthened. Enterprise surplus increased. And that word, well, it really matters, surplus. State Farm is what's called a mutual company. Policyholders are technically members. When surplus builds beyond internal targets, management has the ability to return capital in the form of a dividend. That's what this is. This is what we're looking at. The idea isn't unusual, though, but the size is $5 billion is not routine. So, what drove it? Looks like from 2022 to 2024, auto insurances were under severe stress. Used vehicle prices had surged, retail prices had spiked, part shortages had slowed claims down, labor became more expensive, litigation costs increased. And in many states, insurers were losing money on auto insurancing, so they raised rates. Now, fast forward, supply chains have stabilized. Used car values have cooled, rate increases finally caught up with the cost of the environment. When profitability normalizes quickly, surplus can build quickly as well. And that's the backdrop. Now, let's take a look at the practical aspect of it. And there's a little bit of confusion here. I want to clear that up right off the bat. This dividend applies to State Farm private passenger auto policy holders. You generally must have an active auto policy during the eligibility window. You generally must have an active auto policy during the eligibility window, and it's got to be enforced when the dividend was declared, and it has to be in the name of the insured. You do not have to apply. You don't have to call your agent. It's automatic. Now, here's the detail that really matters. The average payout being discussed is about $100 per policy, not per vehicle, per policy. So if you have one policy covering 4 cars, that's typically one dividend tied to the policy number. If you have 2 separate policies, you may receive 2 dividends. If vehicles are insured under separate households with separate policy numbers, each policy is evaluated independently. So 4 cars does not necessarily automatically mean 4 checks. It depends on how your coverage is structured. The dividend usually arrives as a mail check or a credit applied to your next premium. Timing varies by state, but historically, these are processed within weeks of the announcement. So should be looking at next week sometime, hopefully. Now, here's a stickler. If you recently canceled before the declaration date, you're likely not going to qualify. If you switched carriers last month, you may not qualify. This is the policy math, not the vehicle math. The distinction matters here. Now, let's look at what policyholders actually have been experiencing. If you were paying $1,200 per year in 2021 and your premium rose to $1,800, that's $600 more per year. And over 3 years, that's $1,800 in additional premium. Now, you receive roughly $100 back. Helpful, but it does not reset your base rate. And here's where the structural question really comes into play. If underwriting is so healthy again, at what point should base premiums reflect the improvement? Good question. That's the part I want to understand as well. In aviation, you don't just fixate on one instrument that can cause bad things. You scan the entire panel. Insurance, from what I understand, kind of works in the same way. While auto policy profitability improves, homeowner insurance in certain states remain under stress. Wildfire exposures in places like California has created significant losses in recent years. I think we talked about California for an entire episode. California operates under Proposition 103. Rate increases require regulatory approval. Filings are reviewed. The insurance commissioner is elected. The system was designed for consumer protection. But when catastrophic rates increase faster than rate approvals, pressure begins to build within the balance sheet. And several carriers have reduced or even paused new homeowner businesses in California. I wonder why. Yet legacy exposure remains. Losses continue to flow through enterprise results. That matters when you look at capital decisions. Large insurers operate across multiple lines, for example, auto, homeowner, life, commercial. Capital sits in the enterprise level. That does not mean your auto premium directly funds fire claims in a simple one-to-one comparison or exchange. But volatility in one segment influences overall capital strategies. So in some ways, it does touch it. Insurance is not just about pricing individual policies, it's about managing surplus across the entire enterprise. When one line builds strongly while the other remains volatile or laggard, management evaluates their options. Which brings us to the key decision. When surplus builds quickly, insurers typically have three options. One, lower base rates. Two, increase reserves. Three, issue a dividend. Lowering base rates requires regulatory filings in every state. A dividend is flexible. It reduces surplus without permanently altering the rate structure. It provides goodwill. It releases excess capital. It acts as a pressure valve. It's temporary, it's strategic, and notably automatic. In retirement planning, volatility and required expenses can be more dangerous than market volatility. Insurance is one of the least discussed, but one of the most unstable line items that we can consider because it doesn't drift gradually, it jumps, it takes moon leaps. And premiums today are influenced by climate modeling, reinsurance pricing, regulatory framework, and enterprise capital allocations, not just your driving record. So, if you're living on fixed income, that matters. A dividend feels good, but structural rate behavior matters more than the check that's arriving. So just cash it. It's your capital. Then pull your declaration page. Confirm how many policies you actually have. Understand whether it was per policy or per vehicle. Shop your coverage periodically and pay attention to how rates behave over time. If underwriting remains strong, when should that strength show up in base pricing? That's the part that I want to understand. Now, I'd like to hear from you guys. How many vehicles do you insure? How many policies do you have? How does this impact you? Did your premium rise over the last 2 years? Did it rise again this year? And when this dividend shows up, how's it going to feel? Is it going to be meaningful or does it feel more temporary? I read the comments below every Sunday. Matter of fact, after the show, I'm getting ready to start answering them now. And many of the next episodes start literally right here because systems matter. But lived experiences tell us how those systems actually feel.